Hey guys, welcome to this week's Money and Investing Show. This week we are discussing the challenge for China, and that is the relocation of many manufacturing businesses to other parts of the world. What does it mean for China? Where's the opportunity for you? And how can you bank some profit? All covered in this podcast. Make sure you take plenty of notes, and as always, make sure you take plenty of action. Hey guys, welcome to this week's Money and Investing Show with me, your host, Andrew Baxter, and as always, my offsider and co-host, Mitchell Laurential.
Thank you for having me on the show, Mr. Baxter. Always a pleasure to be here.
Good to see you, buddy. You looking well?
Thank you very much. You too. Looks like you've been working out a bit.
Keeping it tight.
Speaking of which, we talk about new workout routines. Let's talk about New World Order. That may seem a little bit dramatic for today's topic of conversation, but specifically I want to talk about China. There's been a bit of a shift there.
That's right. New Order is very much the topic of conversation across markets right now. And I think as you reflect, and always think we talk about trading and we do trade postmortems and looking back over your trading, as an economist, you look through the different phases that we've been through. And as the world has come out of the lockdown environment that we obviously have for a couple of years, there are some definitive moves that are going on, obviously geopolitically, with what we're seeing around the world in the Ukraine, and also, to an extent in China with the saber rattling around Taiwan, but also some of the underlying issues that really impacted on the bottom line for companies have sort of come into the foreground and are being addressed. And that's really what this is all about. When it comes to money and investing, anything that impacts on the bottom line is something that deserves a level of scrutiny. So let's see what we can do as far as this is concerned with China.
All right, giddy up. I'm excited, AB. So let's think about the last 15 years of China. Insatiable growth, been an absolute monster.
It has. I mean, the Chinese economy has gone through, no question about it, its own industrial revolution where you've had I don't think it's a word, but a deruralization of the population, where you've gone from having the majority of your people working in agriculture and primary production through into manufacturing. And, that 15-year period has seen, the Chinese economy growing at a blood-curdling rate, from 9-10% on occasions, year on year for a couple of decades now. And it's seen China, get itself front and center as, the world's number 2 economy on the basis of size. And a lot of that has been, predicated and built upon, incredibly cheap labor, which is usually the foundation or bedrock for manufacturing. And also, I guess, the currency, which has been managed at a level, let's use that term, maybe an artificially low level, making it price competitive, and its desire to take on tasks that a lot of the rest of the world doesn't want to do. A good example of that, of course, would be lithium refining, which is, it's not the most environmentally sound. And by virtue, I guess, of China sort of still being classified as a developing country, it's not been under as strict scrutiny from an emissions perspective and all those different things, which has given it a tremendous competitive edge in global markets. So it's become, the world's manufacturing space, rather like, made in Hong Kong. If you go back to the sort of late 70s and early 80s was the case. The challenge with Hong Kong is it's a very small place and it's not really going to become that big a manufacturing center. But China, with its vastness of resources, is very much been that.
So is that over? Because we've actually seen a shift. A lot of US-based companies have actually left China in terms of their manufacturing, right?
There is a shift underway. There's no question about that. And I guess we'll get into the motivation for doing that and what the benefits and what the costs are to that too. But if you look sort of at the history of economics, and economics is really interesting I don't know if it's really interesting, but as a science or a social science, it's relatively new. It's only sort of a couple hundred years old in terms of it being an area of study. And if you look back through history, most current companies go through this phase where originally they're an agricultural subsistence farming type, and then there's a development of resources and manufacturing on the back of it. And probably the best example of that would be the UK, where, you had the Industrial Revolution and manufacturing was very much, the UK was the manufacturing hub of the world. Even the small town where I'm from, Swindon in the UK, was, it's where trains were manufactured for the entire Commonwealth. So it's a huge manufacturing hub, lots of raw materials, lots of coal, lots of cheap labor that had come off the land to work in factories. My dad grew up on a farm, but went into factory work in the 50s and 60s. So that was very much, what the UK did. But by the 1970s, given developments in the labor market and the cost of wages, and in the UK that was probably, pushed along quite considerably by some, left-wing politics as well, it started to become less cost competitive to manufacture in the UK, and you'd look for other places that perhaps were more reliable. Again, I go back to, history leaves clues. Industrial action in the UK meant that it wasn't the most reliable place to get your stuff manufactured, and wages were going up. So off things then went, as I say, to the likes of the Far East, and then subsequent to that, we've seen it then move into China. And then the backfill, you've gone from agriculture into primary resource generation and mining, into manufacturing, then into services, which is really what the UK's economy is largely based around now. So we may well see that for China as it moves further along that evolution pathway. And there are consequences for that too. For many companies looking at the impact of pandemic, China's continued policy of wanting a lockdown to have a zero infection rate effectively in its country has meant that the reliability of manufacturing and the ability to get components has been compromised. So you've got great cheap labor, but that ability to get those components, the things that you need to finish your goods to then be able to sell them to market, has been compromised. Add to that things like the Suez Canal and general transportation, ports being shut down, and so on and so forth. It's called a lot of companies to really call into question their just-in-time management process, where instead of having large stockpiles of components, you almost make to order, it gets shipped to you a couple of days before you need it, it gets put in the goods, and you don't tie up too much of your working capital in parts and components and so on. This is the theory behind it.
Sure.
And given the post-pandemic world and with the lockdown still happening in China, it's called into question whether that's a valid strategy. So the net impact of that, and I think Samsung were probably one of the early movers on this way back in, I think, probably 2019, so 3 years ago.
Sure.
Had already started on this process, and we've seen Microsoft do the same thing now, and Apple is probably the best example, the easiest one to use, where the earbuds are now being manufactured in Vietnam, the phones are now being manufactured in China, I beg your pardon, in India, whereas prior to this, that was all being manufactured in China. And it's been moved across to those other countries, potentially because it's a more reliable source of componentry that doesn't affect the supply chain for the company.
So if you're a company you were looking to produce or manufacture, in China, what are the real risks that you'd be weighing up right now?
The big risks, I guess, are government policy, number one. I guess there's also a risk of commercial espionage to an extent, and that wouldn't be my view. I think more with, say, the US policy of limiting investment in tech, for example, and particularly sensitive technology in China, points to the fact that there is a concern that there could be copybook type product development on the back of IP from other places. Whether that's true or not, I don't know, but that's where the policy kind of seems to sit. So they're two pretty big risks, and I guess you've just got that unpredictability. If there's a further lockdown on the back of health policy, then that could really negatively impact on your business if you get a primary component from that space. So they're all very valid supply chain risks for those companies. So by moving somewhere that there's maybe a more reliable source of that's starting to happen. The flip side, and particularly as we're in earnings season, where we're looking at companies under a fair amount of pressure in terms of earnings growth or slowing earnings, where you've got higher labor costs, you've got higher energy costs, you've got a very strong US dollar, which isn't great for US exports. A 21 and a bit % move in the US dollar this year will take about 10.5% off earnings across the S&P companies, just to put a sort of quantum on that. There is a bit of pressure there. And now if you're moving your manufacturing center from a low cost to a slightly less low cost, it's not expensive, but it's not cheap anymore.
Sure.
It's I don't think the grammar's quite correct on that, but it's a less low cost environment to grow in. The trade-off being you've got a more reliable source of production is where those companies are going. So they'll wear that in their earnings, but the flip side is you've probably got a more reliable supply chain.
So if you're China right now, what would you be changing or needing to do to keep those companies manufacturing in China?
Look, I think China's got a lot on its plate with its own domestic economy right now. I mean, we've got a property market which, to all intents and purposes, is imploding.
Weak.
And it stands to reason, given how much it's grown. Nothing lasts forever, and you've had such an unbelievably strong move in that property market there. And this is all predicated on extremely low and currently falling interest rates, which is
only country I know that is actually lowering interest rates, and the rest of the world's putting them up. Weird.
And this is an attempt to obviously prop up its own banking and property sector, or at least it looks that way. So China's got a lot on its plate with its own domestic economy to prevent a major implosion of its property sector, which would then implode its financial sector too, which then cascades through the broader economy. So it's got its plate pretty full. So seeing some companies manufacture stuff outside of China would probably irritate and almost certainly won't be forgotten. But is it a major priority right now? I suspect probably not. They've got their own fish to fry.
So if we look at some more recent examples you spoke of before we went on air about DR Horton, for example, I think it was, who have actually exited China with their manufacturing.
It's broad based. We talked about a couple of tech companies, probably about as blue blood. Well, you don't bleed blue, you bleed green. If you're a John Deere, that's a farming joke. So anyone that's in the farming community will know what I'm talking about there. John Deere have just relocated their manufacturing from China for their headers, their combine harvesters, for all intents and purposes, down into Louisiana. And one of the issues for them in doing that, their labor costs about $47,000 a year on a production line, which is relatively high for a US production line type job. But I guess what it means is that you've got this continuous, reliable supply of componentry and product that you can then sell. So the cost base moving higher is offset by your sales revenue moving up. Also, John Deere as an organization, you find this is just one of the most divisive conversations in farming community as to the where you get your stuff from. Have you got a Massey Ferguson or a Kubota or a Mahindra or a John Deere tractor for anyone in that space? And there's a huge brand loyalty because of the servicing component that comes with it. John Deere being American is true apple pie America, and the fact that they've relocated their manufacturing, I think, is a brilliant PR move for the company in the first instance. But I think it plants a big flag for the US in believing that it can be a manufacturer again. And I think it's going to be the first of many that you see. And I mean, it's not a huge amount of jobs. It's like 1,200 jobs or something like that. So it's not significant to any great extent, but it's way more significant than the statistic shows because the rationale and the reasoning behind it is pure and true.
Absolutely. It's interesting when you really think about it like that. And I guess the big question for today, AB, this is the money and investing show after all. Within all of this, where does the investment opportunity lie?
We'll get the chocolate wheel out for that one, shall we?
Come on.
I've got a wild card theory on that, which I've sort of been tabling for a couple of months, and I've been ruminating on this.
Can we have it today?
Yeah, I think we can have it today. The biggest issues for the globe is moving stuff around, and we saw that with the Suez Canal when that went down. It wreaked havoc, which actually still hasn't completely played out. There's still backlogs in some instances of things. So removing the requirement to ship stuff would be fantastic from a manufacturing perspective because it removes a variable that can be impacted by weather and other factors. So something doesn't require shipping by sea is good. Secondly is that stability of workforce and government where the goalposts don't move in terms of government policy too much. Now, if we look at the US economy per se, for the US, manufacturing in the US, we've talked about John Deere, and BMW actually moved one of their plants from Mexico to Canada some time back, and more companies are bringing money back. There's billions going into building factories. But within that complex of North America, so if we take Canada, and we take the US and then take Mexico, they're all party to what's called the NAFTA, which is a North American Free Trade Agreement. So there are an extremely compelling trade relationships between those three countries. And it makes sense given the level of borders or lack of border in the case of the South. But nonetheless, economic borders, if we can call them that. And so if you're a US manufacturer and you've got the opportunity to keep something closer to home where you don't need to ship it overseas, you can put it on road or rail. I think Mexico is my wild card here.
Ooh,
you've got a significant workforce, which is a cheap workforce to employ on an hourly basis. You've got no trade tariffs. You've got already pre-existing and fairly inflexible in a good way, as far as the goalposts aren't moving, trade relations through NAFTA, and you're in the same time zone. are all very, very compelling reasons for manufacturers to perhaps start looking at Mexico as the go-to lower level manufacturing. I'm not talking about like high-end aerospace and telecommunication type stuff yet. That will come. But that movement into that basic manufacturing and then value-add manufacturing and then automobile manufacturing and then gradually up the pipeline until you get into like tech manufacturing is a very, very real prospect. And yeah, as a wild card, and there are a couple of ETFs that are in the...
My next question, you beat me to it.
Yeah, so there are a couple of ETFs, exchange traded funds, to look at in Mexico. MEXX is one of them. There's a couple of others that I'll probably run through for those people that subscribe to our ETF service. That these aren't quick, in you go, out you go, here's some money. This is a more long-term strategic move as perhaps the Mexican economy starts to move. Again, you talk about the movement off the land into manufacturing. You know, Mexico is also a decent primary producer of agricultural goods. You start to see that migration through from working on the land to working in the factory and all the way through. And I reckon it'll be really interesting to see over the next 5 to 10 years. That's a big way. For me, that's a massive time frame.
That is a long
I find
time.
it hard to talk about investing.
You might not make it past that time.
Oh, come on, mate.
You got 5 kids. You got stress.
Yeah, nah, under control. I've got a great wife that handles all of that. But I think it'd be very, very interesting to see over the next 5 to 10 years how Mexico and the US respond to this movement, perhaps away from China, which may become a permanent thing. Maybe it's only temporary. Maybe it's permanent. If it becomes permanent, then I think it plays perfectly into the hand of the Mexican economy. And I think there'll be some wonderful money-making opportunities to make. And heaven knows, we're going through a lot of market turmoil right now. And sometimes looking for the needle in the haystack, whether that be, a stock that's likely to, and I'll talk about a couple of examples of that in a moment, actually, if you remind me, a stock that may be an outlier that performs differently to the market, or a country, an emerging market that performs outside of what the globe is doing, is where there's some great coin to be made. And I love special situations investing. It stimulates me intellectually when you find it and you're able to capitalize on it. And gee, they're bell ringers when they come in. So that you can't build an entire investment strategy on special situations, but if you've identified something and you get a decent crack at it, you can make some really good money with that.
I know how well you've done this year in particular.
So if we talk, I'll give you a couple of companies as an example.
Yes, please. That's your reminder, please.
So one of the things that we've talked about is the disruption in supply chain because of distribution and shutdowns and things like that. What that's resulted in for certain companies and certain sectors is now you've got an inventory, an amount of stock that's growing faster than sales. So I'll give you an example. Skoda, which I think are part of Volkswagen Group now, I think the car manufacturer.
Yeah, maybe.
So they had, I think it was like 100,000 or maybe it was 1 million finished cars sitting on the dock, except for they weren't finished, they were waiting for a component. So they've continued on with their manufacturing, building the car, waiting for the chip. Now the chip's in, they've got this huge inventory of cars to now better push through to markets. And they probably have pre-sales on those, so they'll be gone. A different order to that might be, if you've been in this situation where you've been starved of being able to get the parts you need for your business, and then all of a sudden things open up, so you order more than what you need. And we've seen this at a grassroots level in the supermarket, where Karen and friends are in their Coles, buying 1,000 rolls of toilet roll because there won't be any toilet roll tomorrow.
Crazy.
That over-order then causes further supply chain issues, which causes inflation and jacks up price, and that's part of the reason why we've got a little bit of inflation right now. So companies have over-ordered to try and make up for that shortfall of raw materials or goods or whatever it may be that they've got. And that's now started to be fulfilled. So they're starting to build up the amount of inventory they have. And businesses don't like holding inventory for two reasons. Number one, it ties up capital. You've got a finished product that you haven't sold yet, and you've paid for it to be built. You need to dollarize it by selling it. So large levels of inventory. And if I sort of go back to the early days of my career, retail was an area to watch a lot in terms of a sector. Inventory buildup is a crucial thing in retail. When you start to see that, it's carnage, because you've got way more than what you want to have to sell, but you have to sell it. If you think about this in the apparel and clothing space, apparel is such a clumsy word to describe.
It is weird, isn't it? Especially on air.
Yeah. So if you're in the clothing space, you've got all this clothes that's now come in because you're out of stock before and you've over-ordered. Now you've got all this, but the consumer's slowed down a bit and you're finding it hard work to sell. The challenge with clothing is that it's this season. And, you look at how fast the clothing industry and fashions change. You think about Zara, every quarter there's a whole new range and everyone's on that quarterly sort of treadmill now. That stock has to go, because if you don't sell it now, it's got to go in the discount bin to get it out the door. And then if it's in the discount bin and you've got a cost-conscious customer, they're probably going to buy the cheap stuff and not your current stock, which means you're going to have a further inventory build-up down the line. Ugly situation, and causes huge angst and unrest in the retail space, especially in clothing. So where's the beneficiary in that? And this is where companies like Ross Stores, for example, or Dollar Tree, or the other one was
Ollie's Bargain Hunt.
Ollie's Bargain Hunt. These sort of $3 bargain type stores. So Ross Stores buy the surplus from the department stores and then move it out at cents in the dollar. So if you've got a cost-conscious consumer, that's where they go. Used to be a great one called Century 21 in New York.
I remember that.
Yeah, they went bust, unfortunately. I don't know how you go bust. It's such a good business model, but I think during the pandemic they went under. But have a look at the likes of Ross Stores, Ollie, Dollar Tree. That sector, I think, is a major beneficiary, because there's all this huge inventory and supply that's sitting there that's got to be pushed out the door. Their buying power means that they can buy even cheaper and move it on to a cost-conscious consumer. So this notion of managing your supply chain can have vast-reaching implications, whether it's a movement out of a country into another locale that doesn't have water between it and its main market, maybe more sympathetic regulations and tariffs, and a very ready, cheap workforce. Don't forget, of course, China's workforce has become more expensive as it's become a more urbanized economy. So now it's not necessarily the cheap place that it was. It's still cheap, but not as cheap as it was. So that switch cost to somewhere like Mexico may just prove to be the move. In just the same way, look for companies that have got that build-up of inventory in just the same way, where they've had supply chain issues. And, if you think about, just at random, if you take, say, Foot Locker or Abercrombie & Fitch or any of those sort of mass market places you find in the shopping mall, if they've got big backlogs of inventory, they have to move it through the door. And if their sales are slowing down on the back of slowing consumer spending, then look out for the opportunity, not just their price falling, but the rising star of the discount resellers, because they will make a killing in this market. And oftentimes people it's a bit of a grotty business. Where there's muck, there's brass, very famous Yorkshire expression. So where there's mud or something that doesn't look tidy, there's a lot of money to make. Where there's muck, there's brass. And I think the likes of Ross Stores and Dollar Tree and whatnot have got the potential to have a ripper of a run in this market too.
It's really high level stuff, and listening to that, I'm amazed, AB. Just the levels of analysis that one leads to the other, the way you connect those dots is awesome. Unashamed plug, fundamental analysis, what we teach through Australian investment education to do exactly that.
That's right. And, everybody looks, only some people see. And the whole purpose of what we do here on Money Investing each week is to try and provide in a bite-sized chunk, maybe a bit of a bigger bite this week,
Big bite.
But in a bite-sized chunk, another piece in the puzzle so that people can start to understand what's going on out there. And just because the news you may see is clouded with a little bit of a negative tinge, markets are a zero-sum game. Whenever there's a negative somewhere, there's a positive somewhere else, so you get that equilibrium. If we're talking about a negative over China, where's the positive? It could be Mexico. If we're talking about a negative for companies that got a large amount of stock held in the warehouse, where's the positive? It's in the discount retailer that'll be pushing it out the door at the end of the season. And that's the key, I think, is to look not just where the bad news is, but try and join the dots to see, okay, if it's a rising tide or fall on one side, a rise on the other, what's on the other side of the seesaw? Where can I put my money and try and capitalize on it? And yes, that is a high level skill, but hopefully the pearls of wisdom that we've shared today has been able to break it down and articulate in a really simple, easy to follow way where people can make some money, because that's really what our purpose is to help our ecosystem make money.
Absolutely. Two sides to every coin, AB. Thank you very much for your time today. That was awesome.
Absolute pleasure. Anytime, Mitch. There you have it, guys. Make sure you give us a review and a rating, and we'll look forward to hosting you next week.